Welcome to Chapter 22 of Essentials of Healthcare Finance, Working Capital and Cash Management. In the daily operations of healthcare organizations, there is an ongoing series of cash inflows and outflows to pay for day-to-day expenses, for things like supplies and salaries. Management must ensure that the organization has sufficient funds available to pay for these items on a timely basis. This is particularly problematic in healthcare, where it is not unusual for payments to be received more than 2 months after the patient or third party has been billed for the services received, and where organizations have high labor and supply costs and thin margins. So in this chapter, we will deal with how firms should manage their short-term working capital and cash. A firm's value may be negatively impacted by working capital inefficiencies, illiquidity, and policies adversely affecting customer relationships. This chapter will provide a discussion of the working capital concept, cash conversion cycles, financing, and investment of cash. Our learning objectives are to explain why cash management is especially crucial in most sectors of the health industry, explain what working capital is and why it is needed, describe the activities covered in the cash budget that affect working capital, describe the tools that an organization manager can use to manage receivables, list the external resources available to an organization for its short-term financing needs, and list and explain the criteria that should be used when investing an organization's cash in the short term. Hospitals, compared with firms of similar size in other industries, have large sums of investment-eligible funds. In 2007, 30% of total net income was derived from non-operating sources, for example, donations or investment income. Investment income is the predominant source of non-operating revenue. Not-for-profit firms need to set aside funds for plant and equipment replacement. Investor-owned firms rely on issuance of new stockholder equity to finance replacement needs. Firms are beginning to self-insure all or a portion of their professional liability risk, and many firms receive gifts and endowments that can provide sources of investment. Many firms have funding requirements for pension plans and debt service associated with bond issuance. Here we have figure 22.1, which is the cash conversion cycle, which really shows and illustrates the main objective, which is to minimize the collection period and maximize the payment period. The cash budget is the primary tool in cash planning. Its major purpose is to prepare accurate estimates of future cash flows for short-term financing or investment decisions. Cash balances are affected by changes in working capital over time. Working capital is the difference between current assets and current liabilities. Current assets, cash and investments, accounts receivable, inventories, and other current assets, and current liabilities are accounts payable, accrued salaries and wages, accrued expenses, notes payable, and current position of long-term debt. The cash budget focuses on 4 major activities: purchasing of resources, production or sale of service, billing, and collection. And these activities represent intervals in the cash conversion cycle. Cash budget activities include purchasing, which relates to acquisition of supplies and labor, production and sale. So in the healthcare industry, there's little distinction between production and sale, meaning there's not really a lot of inventory or products or services unless you are in a specialty practice that provides those types of things. Billing is the interval between the release or discharge of a patient and the generation of a bill, and collection is the interval between the generation of a bill and the actual collection of the cash from the patient or the third-party payer. The steps in the cash management process are 1. To understand and manage cash conversion cycle. 2. Develop cash budget that accurately projects cash inflows and outflows. Establish the firm's minimum cash balance. Establish working capital loans when short-term financing is needed. And 5. Invest cash surplus to maximize expected yield. Working capital management is related to short-term bank financing and investment of cash surpluses. Consider two major categories on the balance sheet and how they relate to working capital management. Accounts receivable. Remember that accounts receivable represents revenue for services that have been performed but have yet to be paid. It usually represents 40 to 50% of a hospital's total current assets. Management of accounts receivable focuses on minimizing lost charges, making sure that everything gets captured, minimizing write-offs for uncollectible accounts, and minimizing the accounts receivable collection cycle. So admissions to discharge on the average is about 5 days. Shortening this interval is not the main objective from an AR viewpoint. However, with fixed prices per case, a reduced length of stay is desirable from cost management viewpoints. To expedite later collection, first determine if interim billings are possible for patients with long-term lengths of stay, use advanced deposits for non-emergent admissions, obtain insurance and eligibility information before admission for non-emergencies, and arrange for a deductible portion of coverage for patients with health savings accounts. The discharge to bill completion timeframe is usually 10 days, but ideally should be reduced. Acceleration of billing processes can create a reduction in final payments. To execute billing, implement timely billing to avoid bottlenecks. Develop educational programs to show the effects of late completion of medical charts by physicians. Bill completion to receipt by the payer usually takes 2 days, but may be shorter where electronic claim submission is used, which is pretty much everywhere these days. To shorten the interval, consider electronic invoicing if you're not already for large payers when possible, and try to settle all outpatient accounts at the point of discharge of departure, and submit a bill for any deductible and co-payments for inpatients at the point of discharge. Receipt by payer to mailing of the payment. It takes usually about 35 days, but varies by type of payer. To shorten the interval, sell some accounts receivable, use discounts for prompt payment, create a system of fast response to third-party requests for additional data, claim all bad debt of the Medicare deductible and co-payment portion of hospital bills, and make frequent follow-up calls to patients to detect problems with bills. Payment mailed to receipt by hospital. That time frame is usually 2 days due to the mail time. Courier service could be used for government or large insurance payers, and wire transfers between payer and the healthcare provider's bank are also used. Receipt by the hospital to the deposit in the bank is usually 1 or more days. To shorten the interval, use a lockbox arrangement where payments go directly to a post office box that is cleared at least once a day by bank employees. Because there is usually a cost for the service, the hospital must determine whether improvement in the cash flow is worth the fee. For most payers in today's environment, they process their payments via direct deposit straight to the organization's bank account. Accounts payable and accrued salaries and wages are not usually negotiated and vary directly with the level of operations. It usually represents a sizable portion of a hospital's financing, and most firms prefer to slow these payments. Approaches to slow accounts payable. Delay payment until the actual due date. Stretch the accounts payable, meaning delay the payment until sometime after the due date. Change the frequency of payroll, for example, from weekly to biweekly. Use banks in distant cities to pay vendors and employees, which delays check clearing and creates float time, which is the difference between bank balance and checkbook balance. And then schedule deposits to checking accounts to match expected disbursements on a daily basis. Short-term financing sources include commercial banks, which are the predominant source, and then there's other sources such as a single payment loan, a line of credit, revolving credit agreements, term loans, or letters of credit. A single payment loan is usually given for a specific purpose, for example, to purchase inventory. The main types are discount arrangement, where interest is computed and deducted from the face value of the note, and an add-on note, where interest is added to the final payment of the loan, but the borrower receives full value of the loan when the loan is originated. A line of credit is an agreement that permits a firm to borrow up to a specified limit during a defined loan period. For example, $2 million to a hospital during a 1-year period. Main types are committed, where there's a written agreement with terms and conditions. A commitment fee is charged by the bank to cover the costs and risks of the money it is legally required to lend. And uncommitted, no formal agreement on the part of the bank to loan money. Revolving credit agreements are similar to a line of credit, but are issued for 2 to 3 years. Most are renegotiated before maturity. If renegotiation occurs more than 1 year before maturity, the loan may be stated as long-term debt, and it never appears as a current liability on the firm's balance sheet. Interest rates are usually variable. Term loans are made for a specific period, usually 2 to 7 years. They require periodic installment payments of the principal. They're frequently used to finance tangible assets that will produce income in the future. The asset acquired may be pledged as collateral for the loan. A letter of credit is a letter from a bank stating that a loan will be made if certain conditions are met. It's used by some hospitals as a method of bond insurance and guarantees payment of the loan if the hospital defaults. Cash surplus is money exceeding a minimum balance required to meet immediate operating expenses and minor contingencies of a firm, plus compensating balance required at its banks. Money market investments take a portion of a firm's investment funds and apply it in the money market, which is a market for short-term securities. For example, U.S. Treasury bills, negotiable certificates of deposit, bankers' acceptances, commercial paper, repurchase agreements, etc. Maturity ranges from 1 day to 1 year. Investment serves 2 roles. 1, liquidity, which is a reserve that can be used if the firm experiences a need for these funds. And 2, temporary investment of surplus funds that can result in a return. The main investment criteria for alternative investment strategies are price stability, safety of principal, marketability, maturity, and yield. Price stability is a very important factor, especially for money market investments. Most money market investments can be sold at a guaranteed price. U.S. Treasury bills are the most creditworthy investments, followed by other U.S. Treasury obligations and federal agency issues. Safety of the principal is the expectation that the principal of an investment is not at risk. Treasury and federal agency obligations are low risk. Bank securities, such as negotiable certificates of deposit, and corporate obligations, for example, commercial paper, may incur a loss of principal through default. Bank creditworthiness can be reviewed in Moody's Bank and Finance Manual and Polk's World Bank Directory. Marketability is the ability to sell a security quickly with little price concession before maturity. To ensure its existence, an active secondary trading market must exist. Some commercial paper, especially of industrial firms, may be difficult to redeem before maturity. Maturity is the date when a note, bill, a bond becomes due for repayment. The relationship with the yield of a security can be summarized in a yield curve. The yield curve is the relationship between the interest rate and the time to maturity of debt. Some firms use riding the yield curve strategy, where the investments are made in longer-term securities that are sold before maturity. The yield is the measure of the investment's return. It's usually affected by maturity, expected default risk of principal, marketability, and price stability. The taxability issue is for not-for-profit firms, which have no incentive to invest in securities that are exempt from federal income tax.